If you had put $10,000 in Bitcoin during the 2016 halving, it would have turned into $350,000 just 17 months later. That same $10,000 invested during the 2020 halving would have grown to $65,000 over the next 17 months. But in both instances, Bitcoin saw over a 75% decline in the following 12 months. Fast forward to today, and Bitcoin has already delivered over 100% return from its April 2024 halving. But more importantly, we've now reached the 17-month window that coincided with the end of the last two bull markets. This timeline is based on what's known as the Bitcoin 4-year cycle theory. According to this, Bitcoin tends to move on approximately a 4-year timeline, wherein price rallies for the first 17 months after the halving, followed by a 12-month bear market, and then about a 17-month recovery phase heading into the next halving. If Bitcoin were to follow this trajectory again and see another 75% bear market, it could hypothetically take the price down to around $30,000 by late 2026. But heading into the last two Bitcoin bull market tops, we also saw an overheated sign from key on-chain metrics. This chart shows a composite of those metrics. In late 2017 and early 2021, over 90% of these indicators were triggered, suggesting the buildup of irrational euphoria. Today, this composite is still at zero, meaning not a single on-chain indicator is pointing to a bull market top for Bitcoin right now. So on one hand, the 4-year cycle timeline is warning of a potential downturn, but on the other hand, Bitcoin's internal health suggests the bull market may have further room to run. To evaluate whether we're likely on the verge of another bear market, we need to first understand what drives Bitcoin's 4-year cycle. This pattern mirrors something called the business cycle, a phenomenon where the economy expands as growth and jobs rise, then slows into a downturn or recession, and eventually recovers before starting the process again. One of the clearest ways to track this is through something called the ISM Manufacturing PMI Index. This is a monthly survey that tells us whether the US economy is picking up or slowing down. A reading above 50 is associated with expansion, below 50 points to contraction, and around 50 suggests the economy is in a neutral state. Every time the PMI has risen sharply from below 50, it's marked the beginning of an economic recovery and expansion phase, and if we put Bitcoin's price on top, those periods have coincided with some of the strongest rallies, because economic acceleration boosts investor confidence and increases speculative capital, both of which are fuel for risk assets like Bitcoin. And the opposite happens when the PMI falls from high levels to under 50, indicating an economic contraction. These are instances when Bitcoin also tends to see its sharpest drawdowns. Now, throughout Bitcoin's recent bull run, the PMI has remained around the 50 level. Put simply, Bitcoin has been rising during a period where the economy has basically been neutral. This is quite different from the textbook bull runs of the past, which were fueled by a clear pickup in economic activity. A key factor driving this difference is likely institutional demand. This chart tracks the total amount of Bitcoin held by ETFs, a good proxy to understand institutional demand. Back in 2023, these funds held only around $10 billion worth of Bitcoin. Today, it's risen to over $130 billion. That's nearly 7% of Bitcoin's total circulating supply accumulated in just 2 years. Now, if we add Bitcoin on top, we see that the two lines move quite closely together. So a large part of Bitcoin's price movement can be explained by the aggressive rise in institutional demand we've seen this cycle. A better way to look at this is through this chart, showing how much of Bitcoin's price movement can be explained by these ETF flows. Since 2023, we can see that ETF flows have gone from having a minor influence to now explaining nearly 50% of Bitcoin's moves. This could be because this cycle has been primarily driven by institutions, unlike the previous cycles that were dominated by retail interest. For instance, Wells Fargo has disclosed a $160 million exposure to Bitcoin ETFs. Harvard's endowment now holds nearly $500 million of Bitcoin, based on public filings. And Morgan Stanley and Bank of America are suggesting its clients to allocate up to 4% of their portfolios into Bitcoin. So across the board, some of the most conservative institutions in the world are no longer debating whether Bitcoin belongs in portfolios, but rather how large that allocation should be. This structural shift in demand could be a key reason why this cycle has behaved differently from the ones before. However, consistent institutional demand ultimately depends on the state of the broader economy. That's because institutions naturally tend to allocate more aggressively when economic growth is stable and macro conditions are supportive, or in other words, when the PMI is pointing toward economic acceleration. So whether Bitcoin sees a typical 4-year cycle play out or not likely likely depends on institutional demand from here, which in turn hinges on where the PMI goes next. If we take the chart of the PMI and add this other line on top, showing the performance of industrial metals, we see a close relationship between the two lines. And this makes sense because these metals, like copper, zinc, and nickel, are a core component for construction, manufacturing, and infrastructure, making them an important gauge for economic activity. Recently, the industrial metals index has been rising, a move that historically aligns with a pickup in the PMI. This would suggest that the business cycle is beginning to re-accelerate, the kind of backdrop that's ideal for higher institutional demand. That's probably why famous investors like Cathie Wood and institutions like Bernstein are calling the 4-year cycle dead, because they believe that an increase in institutional capital driven by a pickup in the business cycle could potentially drive Bitcoin higher without experiencing a typical 12-month bear market. But there are no guarantees in the market. If the PMI were to roll over into contraction from here, it would create an unfavorable backdrop for institutional demand and increase the risk of a traditional Bitcoin bear market consistent with the 4-year cycle. For that scenario to unfold, though, we would likely need a catalyst, such as an economic recession. After all, if we zoom out and add recession bars on top, we see that all of them lead to a deeper contraction in economic activity. This is because a recessionary environment forces businesses to cut production, reduce investment, and increase layoffs, causing an economic shutdown. To evaluate the risk of a recession in the next 12 months, we can look at this model created by the Federal Reserve. Historically, heading into every single downturn since 1960, this line saw the odds of a recession spike to above 25%. Now in 2023 and 2024, we did see a similar spike where recession odds reached as high as 70%, but the economy has managed to remain resilient, which has helped bring down these odds down to 25%. This suggests the immediate threat of a recession in 2026 is actually receding, but it's important to keep this development in context, because even after this decline, recession odds still remain historically elevated compared to what we typically see during periods of healthy economic expansion. In strong growth environments, this number usually sits below 10%. So while the immediate threat of a recession appears to have eased, the economy is not yet back in a low-risk, all-clear type of regime. That's why recession odds and the PMI remain the two key variables to monitor from here to evaluate if institutions are likely to aggressively allocate into Bitcoin, potentially extending the traditional 4-year cycle. At Capital.com, we'll keep you posted on such important macro indicators for Bitcoin. Hit like and subscribe to stay tuned. Thank you for watching.